Recording in progress.
Good afternoon, everybody. And on behalf of the Institute of Chartered Accountants of India, the Corporate Laws and the Corporate Governance Committee, I take great pleasure in extending a very, very warm and a very hearty welcome to all of you to this webinar session on CARO. As we all know, the CARO has been amended by the Ministry of Corporate Affairs, and we have a new version of CARO that's coming in this year for financial statements reporting periods commencing on or after April 1, 2021. And in this regard, we've organized this webinar so that you can hear from an expert. Also take this opportunity to extend a very warm welcome to CA Vishal Doshi, a Central Council member, a past member of the Western India Regional Council. So for those of you in the West, Vishalji would need very little introduction. But for the others, and I'm told we have about 1,300 members who had logged in until a couple of minutes back, and I'm sure the numbers are growing now. But for the rest of you, let me present a very short introduction of CA Vishal Doshi. CA Vishal Doshi is from Baroda. He's a partner with KC Mehta and Company. And in the few days of interactions I've had with him in the Central Council, I found him to be exemplarily knowledgeable and a very, very consummate and a very articulate speaker who speaks to the point. Again, there's something about Vishalji that I'd like to specially mention. He runs his own small little private, which I'm sure is not little anymore, a private knowledge sharing initiative called the VI series, where he puts out very, very relevant content. In fact, this is how I knew him before I met him in the council, because I happen to have read and used his updates as well. He makes these small snippets on trying to make knowledge more accessible to a user, because we've now become more the C generation, as in SEE, rather than the read generation. So we want to see and we want to hear, which is why I think these webinars and the VCMs have been hugely successful. So we look forward to a very, very good presentation from Shri Vishal this afternoon. It's on CARO 2020. Just in terms of CARO 2020, I'd like to just spend a few minutes introducing the topic. Most of us would think CARO is very punitive. Why did the government have to give us more work? But I just want you to stop for a minute and think. The last decade has been transformational, both in sense of enhanced awareness on corporate governance. Everybody now knows what to do. But the last decade has also seen very, very large failures, and failures from a lot of elements of the system. There have been credit rating failures, there have been bank failures, there have been governance failures, there have been board failures, there have been institutional framework failures like what we are seeing recently. So my own view is the government must have thought, okay, which is the one profession that I can saddle this additional work on and expect them to deliver? And I think we've been chosen for something which is a very great task. So please don't think CARO is a burden. I think if all of us are very conscious about a very strong, a very honest, and a very high integrity India, then I think CARO is the answer. Now, CARO came in, and then obviously there were a lot of representations that said, how can you ask an auditor to report on something that the management is not reporting on? So the ministry was very quick to react, and they introduced a slew of changes to Schedule 3, which have actually transformed Schedule 3 from financial reporting to, in my opinion, management reporting. Where would you report pending capital work in progress? It was a management report, but today it's incorporated in a financial reporting framework. So there are many, many changes in CARO and many, many changes in Schedule 3, and I'm sure there's a significant overlap between one with the other. And once again, inviting CA Vishal Doshi to make his presentation. Thank you very much for being here, Vishal sir. Over to Vishalji.
Thank you, Sri Priya ji, for that kind introduction, and also I would say sharing the information about the PI share. Friends, at the outset, I would like to compliment the Corporate Laws and Corporate Governance Committee of the ICI for selecting this topic on CARO and Schedule 3 for today's presentation. And I think today being 1st April, I would not fool anybody. But let me be very honest that it is something that we have to take it extremely seriously for this audits. We all know last night the government deferred the provisions and reporting with respect to audit trail. But as was expected, they have not deferred with respect to Schedule 3 and CARO application. And all of us know that CARO 2020, as the name suggests, it was announced in 2020. It's been 2 years down the line. And Schedule 3 also underwent revision last year, but because of COVID, the government postponed it. So compliments to the whole CLCGC team for selecting this topic. And because I firmly believe that creating awareness on this topic is extremely important. Otherwise, I am not, I would say, making anybody afraid, but yes, it's going to be a challenge in closing this year's financial statements. I remember Sri Priya ji and me interacting on a lot of issues about how do we close these amendments that are there in Schedule 3. And I feel that, yes, it's as good as we have to start from yesterday. So I'll share my screen. Yeah, so I hope my screen is visible.
Yes, sir.
Yes, sir.
Yeah, great. Thanks. So friends, the topic that has been given to me and what we would be discussing and deliberating is on the recent changes in Schedule 3 and CARO. Why these topics are have been taken together is because there are a lot of amendments that are interrelated or common, and therefore rightly selected by the CLCGC that we should consider and discuss these topics together. At the outset, since being a Central Council member, I would put a disclaimer that whatever I would be discussing today, the views, they would be my personal views and not the views of the council or any of its committees. So please bear with me with respect to whatever we discussed today. So friends, first I'll take Schedule 3 because that would be the starting point, and CARO would come after Schedule 3 because Schedule 3 is where the primary responsibility of the preparation of the disclosures would be that of the management. And then as auditors, we will need to verify that. And then after that verification and everything is over, we issue our audit report, of which CARO is a part of the audit report. So Schedule 3, as everybody would be aware, there are 3 divisions to Schedule 3, Division 1, Division 2, Division 3. And just for the benefit of our members, the Division 1 is applicable to companies and NBFCs whose financial statements are under the Accounting Standard Rules 2006. They are typically the AS that we say, and the small companies, the private companies and the NBFCs whose net worth is less than 250 crores are the companies which would be following the accounting standards, and Division 1 of Schedule 3 applies to them. When we go to Division 2, these are more of the larger companies. The listed companies are there which follow Ind AS, and companies which have a net worth in excess of 250 crores which are required to follow Ind AS, they have to comply with Division 2. So these are the companies, these are not the NBFCs which have to follow Division 2. So under Division 2, as per the Ind AS requirements and the requirements of Companies Act, what is required is the balance sheet, a statement of changes in equity, SOCI, that which we normally say, which is not a requirement of the accounting standards or Division 1. We have the PL, we have the cash flow, we have the notes, and also a balance at the beginning of the earliest comparative period. So this is the movement of the retrospective amendments, because there is nothing like a prior period. I'll not go into the accounting standards, but this is just what the Ind AS financials require. And the P&L, it is broken into 2 parts. What we have is the profit and loss, statement of profit and loss, and the other comprehensive income. So to these entities, Division 2 applies. To these companies, I would say Division 2 applies. And Division 3 is for the NBFCs whose financial statements are they are required to follow is the Ind AS. And so for them also, the presentation disclosure requirements as far as the balance sheet, SOCI, P&L is concerned is similar. but these are the NBFCs and division 3 applies to them. So why I'm saying this is because, the amendment that the MCA notification, it has amended division 1, division 2, division 3, all the 3 of them. And there are many of the amendments which are common, and where I would just share which amendment is applicable to which division, which would help our members and fraternity at large. Just to start with a short background, that this Schedule 3 amendments, they were notified on 24th of March 2021. So like I said, it was actually to be applicable immediately on its notification. But now it is applicable from 1st April 21, that is 21-22 financial year, which we would now be closing. A lot of the amendments, they are in Schedule 3 have been carried out to align with CARO 2020. So when CARO 2020 was announced, there were a lot of amendments that were there. New clauses were also incorporated. And then thereafter, the MCA notified Schedule 3, which included a lot of the reporting under CARO, was incorporated in Schedule 3. So the ICI, or I would say rather the CLCGC, has in January 2022 revised the guidance note on the Schedule 3, Division 1, Division 2, and Division 3. They are now available in public domain, and I would request members that you please kindly download them. They are extremely good material, and as they are guidance note, we definitely need to follow them. And I would also request you to kindly go through them clause by clause, and especially after our discussion today. So now we'll start with whatever are the changes that have been notified under Schedule 3. So the first change is about compulsory rounding off. And this is with respect to Division 1. Friends, we would be auditing many financial statements where, full figures are given, including paise. So you have 10 lakhs, 1,200.35. And that is how the financial statements are prepared. They are directly exported from the software, and then they are prepared. We audit them, we sign them off. Now there is a requirement of mandatory rounding off. The mandatory rounding off is that so it applies, like I said, Division 1 also to private companies, inoperative companies, all companies. So where the total income is less than 100 crores, then the rounding off is to be done to the nearest hundreds, thousands, lakhs, or millions, or decimal thereof. And where the total income is in excess of 100 crores, the rounding off is to the nearest lakhs, millions, or crores, or decimal thereof. So please note that this is a mandatory requirement now that the rounding off would be required. When we go to Division 2, so Division 2 also had, so under Ind AS, there was this mandatory requirement of rounding off, but in that the criteria was, the threshold was linked with the turnover. Now, because the total income is to be used in Division 1, even in Division 2, now total income is to be considered instead of turnover when we apply this threshold of 100 crores for the rounding off. So these are some changes. Friends, I would just like here to draw attention that, a lot of these things that we would be discussing today would definitely have an impact with respect to the previous year numbers also. Because we give comparatives, it is mandatory to be given by the management and to be verified by us. And therefore, my request is that since 31st March is over yesterday, most of the compliances we have done, we have completed most of the compliances with respect to various laws. I would request that you please kindly interact, educate your client with whatever are the changes that are there in Schedule 3. And if possible, I would request you that tell your client or support them, do whatever handholding is required, that at least the March 21 numbers under the revised Schedule 3, the amended Schedule 3, I would say, they are prepared. And then on that basis, March 22 would become easier. So the next change is on the face of the balance sheet. And this applies to Division 1, where property, plant, equipment has been now modified, and intangible assets in the heading has been included. And second is in the subheading or the subgrouping, I would say, instead of tangible assets, the words property, plant, and equipment have been replaced. Over here also, friends, I would like to draw attention on one aspect, that when we are following accounting standards, because like I said, Division 1 applies to the accounting standards. Under the accounting standards, in 2016, they were revised. Accounting Standard 10 fixed assets has been renamed as property plant equipment. And second, AS6 on depreciation accounting, that is now no longer there. That has been deleted, that has been omitted. And the provisions of depreciation have been included in AS10 itself. Why I'm sharing this right now is that many times what we do is that at the client's place, they do a copy and paste of the policies and everything of the earlier year. So my request here, friends, is kindly check the significant accounting policies as well as the notes and the financial statements. And wherever you find the words fixed assets, kindly replace them with property plant equipment, because that is what is the requirement of the language. And I would request everybody that we should all be technically correct. And second, wherever references are made to AS6 depreciation accounting, kindly just find that and replace that with the AS10, because depreciation is now under AS10 and AS6 is no longer a standard that is in force. So these are just some snippets, side snippets that I thought I will share to ensure that we are all technically correct and the financial statements that we sign are also proper. With respect to division 2, friends, the lease, you can see, I will not mention about which division it applies. You can see it is there on the top of the band to which division it applies. So this is typically with respect to lease liabilities. Ind AS 116 has been made operative since the last couple of years, and there was always this confusion where lease liabilities are to be presented. So now the balance sheet has been changed, has been modified under the by way of this notification, where lease liabilities, it is now appearing on the face of the balance sheet under, wherein it is a non-current liability, it would come under lease liabilities under a separate head 1A, and where it is current also under financial liabilities, it would be shown separately. So lease liabilities typically earlier, if you see, because there was no concrete guidance on where it is to be reflected in most of the financial statements that I have studied, we have seen that the non-current liabilities were shown under borrowings as a lease obligation. Because I would say the lease obligations typically came from the earlier accounting standard that we have had on leases, and where lease obligation was more towards the finance lease and not towards the operating lease. But now under 116, there is nothing like a finance lease, operating lease. We have to the right of use asset and the lease liabilities. And therefore, lease liabilities, it has been said, mentioned now that it has to be shown separately on the face of the balance sheet, and similarly under current liabilities also. So these are more so for the Ind AS financial statements. So now again, a change that has been made to the SOCI, that we said statement of changes in equity, where we have division 2 and division 3 that it would be applicable. So if you see that there are two portions to it, one is with respect to the equity capital and one is with respect to the reserves that is there. SOCI is split into two portions. So with respect to equity share capital, if there is any change due to prior period errors, then that has to be shown as in a separate column. So this column has been added by way of this notification. And then we have the restated balance at the, so restatement pursuant to the adjustment of the prior period errors with respect to the share capital, and then we have to have the restated balance at the beginning of the current reporting period, and then we have whatever are the changes and balance at the end of the year. So whatever are the changes in the equity capital due to any prior period errors or restated balances, see, because there is a lot of I would say concept under the Ind AS when we say with respect to compound financial instruments, where some equity portion and debt portion would be allocated based on the fair valuation. I'll not, like I said, I'll not go into the accounting aspects, but then in case there is any change under the equity capital, it has to be reflected like this also. Another change is with respect to the remeasurement of the defined benefits plans, which forms part of the OCI when we talk of the statement of profit and loss. But now the change is that the remeasurement of the defined benefit plans and the fair value changes because of the own credit risk of financial liabilities. They shall be reflected or be shown as a separate column under the reserves and surplus, or it can be shown also in the as a separate item in the notes to account. So earlier it was just there as an amount in the notes. Now they have added that or shall be shown as a separate column under reserves and surplus. And another important change is the description of the nature and purpose of each reserve under other reserves shall be disclosed. the earlier provision, earlier Schedule 3 had mentioned that typically in the SOCI schedule, this was there as a footnote that the nature and purpose of each reserve shall be disclosed. So if you see the financial statements of various companies, the annual reports, you will find that they have disclosed for even share premium, what is the nature and purpose, even for the capital reserve. But now what it says that there is a category of other reserves under the reserves and surplus. The nature and purpose of only those special reserves are to be reflected or disclosed in the financial statements by way of this Schedule 3 amendment. Promoters shareholding. This is a new disclosure. So friends, again, I would just like to mention generally that whatever we would be discussing today, they are all general disclosures which are required, or all additional disclosures which are required to be made. So there would be disclosures like, let us say, when we talk of the shareholding, we had a disclosure of shareholding in excess of 5%. So that still continues. In addition to that, the Schedule 3 now requires that whatever are the promoter shareholding, that needs to be disclosed separately in the financial statements. So details shall be given for each class of shares. So you have equity shares, you have preference shares. So the promoter shareholding in each class has to be disclosed. And there is a column, last column, if you see, there is a percentage change during the year. So this percentage change, it will be computed with respect to number at the beginning of the year. What is the percentage change? Or if issued during the year, then for the first time, then with respect to the date of issue, what is the percentage change that has been made? So who is a promoter? It is defined under section 269 of the Companies Act. So see, for a listed company, I don't see that is a great challenge, because they have been disclosing promoters shareholding to the SEBI every quarter, or with a lot of compliances which are to be done. And those which are coming out with the IPOs also, they also have to identify and make disclosures with respect to the promoters. I understand the larger challenge would be for those companies which are not yet required to disclose the promoter shareholding, and they will now need to disclose it for the first time. And as you can see, it is applicable to all types of entities, whether they are following AS or Ind AS. So promoter means the person who has been named as a promoter in the prospectus or is identified by the company in the annual return as a promoter. Second option is a person who has the control over the affairs of the company directly or indirectly, whether as a shareholder, director, or otherwise. So I believe in most of the private companies, this is my view, that the directors, who have the control over the affairs, they would all be classified as promoters. And the third category is that a person in accordance with whose advice, directions, or instructions the board of directors is accustomed to act. So in case there is a professional who is associated with the company and giving guidance on how they should execute their plans, they give direction, that professional gives directions or instructions, but in his professional capacity. So typically, if you ask me, I would say professional capacity would mean that, where a person is raising an invoice for the professional services that are being rendered to such companies for the advice and the directions and instructions, their involvement in the management. If they are all in professional capacity, then they would be excluded from the promoter category. But if they are not advising in their professional capacity, then such persons would also be included as promoters. So even if the promoter has a shareholding in less than 5%, let us say it is 1% or 2%, then this disclosure would also come for such cases of promoters. And we have, like I mentioned, needless to say, it's a standard thumb rule that where whatever disclosures we give, we have to give for the previous year also, the comparatives also. And that is where I mentioned that we should ask our clients that they should start preparing the March 21 financials as per the amended Schedule 3, and therefore March 22 would become easier. Current maturities of long-term debt, this is a reclassification change that has been brought about. So earlier, so these are typically with respect to, let us say, term loans or vehicle loans that a company would be having, where the current maturities would mean that as on the balance sheet date, whatever installments fall due in the next 12 months, they would be current maturities of long-term debt. So till now, the Schedule 3 required it to be shown under current liabilities, or I would say under current liabilities, other current liabilities, and these were reflected. But now what it has been notified is that the current maturities of long-term debt would become part of short-term borrowings. So it would still be under current liabilities, but instead of other current liabilities, it would be reflected as a short-term borrowings. Friends, I would also during the course of my presentation share some of the things which I feel might be relevant. So, and we might as auditors not just look at it from the perspective of the audit, but even for a different perspective, that if the company is borrowing and whatever data they have submitted, because earlier the current maturities of long-term debt was considered under other current liabilities. No adjustments have been made with respect to the ratio analysis or other submissions with respect to the debt. So let us say debt equity ratio, and then this is not considered as debt because it does not form part of the borrowings. In case such things have happened in the past, now because of this reclassification, short-term borrowings would increase, and they would appear as a line item if they have not been appearing so far, and that would come to the knowledge of the bankers or the lenders, and which would have to be considered as part of the ratio. And because borrowings would now be classified as borrowings, which were earlier not identified or not classified, I would say, under borrowings, it would have a negative impact as far as the debt equity ratio and all those are concerned. So just ensure that you inform your clients that wherever they have submitted, they just have a relook at whether this reclassification would have any impact on the submissions they might have made to lenders or anybody else with respect to the borrowings and the debt equities. The next change is with respect to trade payables aging schedule. So friends, till now we always had the trade receivables aging more than 6 months, less than 6 months, typically how we mentioned. But now for the trade payables, also now an aging schedule is required to be given. And like you can see, it is for all classes of companies, division 1, 2, 3. We used to have the bifurcation between MSME and other than MSME. Now you can see that there are various buckets given, which are outstanding for the periods from due date of payment. Less than 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. So these are the buckets that have been given. And we have to classify MSME, others, disputed MSME, disputed others. So now see what impact, if you ask me as an auditor also, what impact it would have maybe as a lender, and because there's a lot of information that is now coming on the face of the financial statements. Let us say some company has got a material amount which is outstanding under undisputed 2 to 3 years. As an auditor, as a outsider, as a lender, I would always question this, that if this amount is undisputed and it is more than 2 to 3 years, or it comes in the 2 to 3 years bracket, or even I would say 1 to 2 years bracket, why is this still appearing? Why is this still outstanding? What are the problems? And I would request that as an auditors, we also need to investigate such amounts further, that if it is undisputed, why is that person not asking? I don't think there would be any person where the contractual term would be more than 1 year from the due date. If you see, the reporting is to be done from the due date of the payment, and a person who has not received or is not asking for money for more than 1 year or for more than 2 years, that would always require I would say a bit of detailed investigation as an auditor. The guidance note, friends, what it says that this amount, the total amount, should match with the trade payables amount that is reflected in the balance sheet. And for that, it suggests 2 additional columns to be put, one which is not due, and second is with respect to unbilled. So if the client has created any provisions or any unbilled payables, then because they have not yet been invoiced, they would not be disclosed as in any of the 4 buckets that have been given in this, and therefore it would be apt to have an additional column of unbilled payables. And not due, definitely where the client has received the company has received the invoice, let us say on 26th of March, and the due date is
sir, is there any
to add an additional not billed column, or not due column, and that those amounts would get plotted over there. Friends, if the due date is not specified or agreed, many times there are such small petty payments with respect to some services, or where due dates have not been mentioned. There are no purchase orders or service orders that might be raised for especially the small companies and all. And then in such a case, what the guidance note wants us is that we have to make the transaction date as the due date, and then we have to plot the aging as per the transaction date. And transaction date would mean that the date on which we recognize the liability as per the applicable accounting standards. So that is what, if there is no such due date that is mentioned. And if the due date is renegotiated or invoice is revised, then you have to consider due date from the original due date or revised due date as per the agreed terms. So if there is a revised agreed terms with respect to due date, then in such cases you have to consider the revised terms and plot the due date or the overdue from that date. But if there is no revision in terms, then the original due date would continue and you have to plot the overdue with respect to that. Disputed, undisputed, friends, what actually constitutes a dispute? Our guidance note also elaborates on that. So it is not necessary that there has to be a legal case that would result in an amount, an overdue amount being classified as disputed. Disputed can be with respect to even quality concerns, it might be with respect to quantity concerns, it might be with respect to the delay in delivering the product or the service. So there can be n number of reasons for disputed, as long as there is a communication and evidence on the part of the company that there is a dispute for which they have held back the payment. So they have to produce necessary audit evidence, which as auditors we must keep in our file. Like, let us say, again taking a hypothetical example, that in more than 3 years for a company, let us say 20% of the creditors appear, overdue creditors appear more than 3 years in the disputed column in that. Then definitely anybody would tomorrow go and would try to ask us that what are the disputes. They would definitely ask the company, but they would have a right to ask the auditor also that what are the disputes, whether you have verified whether it is a genuine dispute or not, whether the email communications are there or some correspondence is there. So all these things we will have to keep in mind when we are classifying any amount under the disputed category. The next change is with respect to disclosure for the property, plant, equipment. Friends, over here, I would request one thing to all of you to kindly go back and check what we have seen. I would say for listed companies, there is hardly any such deviation. But when it comes to the private companies, normally what we have, I would say, you can just refresh yourself as a property, plant, equipment schedule. First item, we have the categories, we have the particulars, then we have the gross block where we show the opening balance, additions during the year, deductions, adjustments or sale, and closing balance of the gross block. Then we have the depreciation block where we have the opening balance, we have depreciation during the year, then we have the reversals and the adjustments during the year, then we have the closing balance. Then we have the net block, current year, previous year. And right at the bottom, we show previous year and the total amount of previous year opening, total of the additions, total of the deductions, total of the closing, right? This is how we show. If yes, then I would request you that from March 22 onwards, please change this, because if you see the requirement, this change was there since 2016, since AS 10 was modified. What it says is that a reconciliation of the gross and net carrying amounts of each class of assets at the beginning and end of the reporting period, showing additions, disposal, which means for each class of assets. So if we have, let us say, plant and machinery, for plant and machinery, we have to show the reconciliation. So we are showing for the current year, but if you see Schedule 3, the requirements are that for each amount, we have to give a comparative. So we have to give for each, for plant and machinery, typically there would be 2 rows. One is for the current year, all the details, and the next is for the previous year. Then we have, let us say, furniture fixture, then we have a current year, all the items. What we are showing as a previous year total right at the bottom is not required. What we have to do is we have to give for each class of assets the details. In case you want a reference, you can pick up the financial statements of any listed company, any annual report, and you will find that they are showing in this way. Either you have 2 block of assets, so one is for the current year, the whole details, one is for the previous year, or within a particular table, you have 2 rows given for each of the class of asset. So additions, disposal, then we have an additional column, acquisition through business combination. So business combination typically is an Ind AS language, but this is applicable for all the three divisions. So let us say you have a merger and there are assets which are acquired on merger, then you have a separate column where you show acquisition through the business combination. In case there is a change due to revaluation, upward or downward, then if you see the schedule 3 requires that if change is 10% or more in the aggregate, then we have to disclose the change of the revaluation. However, para 81 of AS 10 requires that wherever there is a revaluation, irrespective of the percentage change, upward or downward, then that has to be shown separately for the as part of the reconciliation. And as you are all aware that the provisions of accounting standards would override the provisions of schedule 3 wherever there is a conflict. So in this case, that 10% threshold, in my opinion, would not be applicable. We will have to give change due to revaluation, even if it is less than 10%. And then separate adjustments for capitalization under AS 11, foreign exchange rates, adjustment on account of exchange fluctuation for PP. We have the para 46A of AS 11, where there are permissible adjustments of capitalization of forex, capitalization to property, plant, equipment that is permitted, and also with respect to borrowing costs capitalized. So for all these also, we will need to give the adjustment column, and the related depreciation and impairment losses shall be disclosed separately. So these are the movements, these are the details that have to be given for PPE. Disclosures with respect to intangible assets, very similar disclosures are there with respect to, again, for each class of assets under intangible. So if you have under intangible, you have softwares, you have trademarks, you have copyrights, different class of assets, then those movements have to be shown for each class of asset. Where now you have to give additions, disposal, again, acquisition through business combination, revaluation, but as per AS 26, intangible assets revaluation is not permitted, but they have still included that as part of the schedule 3, and other adjustments and the related amortization and the losses, impairment losses or reversals shall be disclosed separately. So whatever disclosures are there for PPE, the tangible assets, the similar disclosures for the intangible assets. Again, a regrouping change for security deposits. Earlier, it was shown under long-term loans and advances as security deposits. Now it would be reflected under other non-current assets. So it will be non-current, more than 12 months, definitely, but it will be shown under the residual category of other non-current assets instead of the long-term L&A that we were reflecting earlier. So these are the amounts where the security deposits have been given, because we are talking of the asset side of the balance sheet. So with respect to Ind AS financials, earlier security deposits were shown under the loans, and now security deposits would have to be classified under other financial assets. Trade receivables aging schedule. So friends, like I said earlier, we had what we used to show was secured, unsecured, considered good, 6 months, more than 6 months, considered doubtful, and then provision for doubtful debt. So typically, this was the disclosures that we used to make. Now, if you see, these are the columns. Trade payables, there is one column in addition to trade payables. Trade payables didn't have this 6 months. It started from 1 year. This trade receivable starts from 6 months because that is what we have been disclosing till date. So we have overdue for less than 6 months, 6 months to 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. Now, again, on the left, if you see, these are the categories where you have to show undisputed, considered good, undisputed, which have significant increase in credit risk. So these are where the credit risk has increased, but there is no need for any provisioning. Undisputed, credit impaired, where you have the provisioning done under that particular category. And then similarly for disputed, considered good, disputed, which have significant increase in credit risk, and disputed, credit impaired. So these are the line items for which you will have to do the whole, this matrix plotting the company will have to do, and which we would have to audit as auditors. So now again, friends, what we discussed like in trade payables, similar challenge would come over here, that let us say for the company is into lending, they have taken working capital limits, and now this disclosure would come with respect to disputed or undisputed. So normally, you know, the working capital limits, you have 90 days credit whatever all the invoices which are outstanding for 90 days. The DP, the drawing power is computed on that. And the rest, the company did not used to disclose much. Now with this matrix, there would be a lot of disclosure that would be coming on the table of the lenders, I would say, even as auditors and of the regulators also. So now, let us say hypothetically again that you have an undisputed amount, a large amount of undisputed credit receivable considered good, which you are putting into the bucket of 2 to 3 years. I believe as an auditor, we should question that if it is undisputed, then why is it outstanding for 2 to 3 years? Kindly justify why we are classifying it as undisputed, or we are not classifying it as having significant increase in credit risk or even a credit impaired when it is outstanding for 2 to 3 years. Similarly, if there is anything disputed in, let us say, 1 to 2 years, then as an auditor, you are expected to ask for all the details. What are the disputes by which this money is not coming? Is there any correspondence? Is there any mail exchange? Is there any suit filed? Whatever. Why is it being classified as a dispute? See, many times the company might be interested that if there is a receivable of 2 to 3 years, and if it puts under undisputed, then there might be a lot of questions from the stakeholders. And then they might find it convenient to put it under disputed if it is 2 to 3 years or more than 3 years. I think this is where, as an auditor, we need to come in and check whether it is actually disputed or not. And if not, we have to ensure that it is classified as undisputed. So here also, friends, under the total column, the guidance note suggests that we should have 2 more columns to match the total with that of the appearing on the face of the balance sheet. So one is with respect to unbilled revenue. We all know that under the percentage of completion method, the billing date and the financial year end date, there might be a difference between the two cutoffs. So on a percentage of completion as in 31st of March, unbilled revenue might have been booked, which might be billed actually in April or May. So that unbilled revenue, you will have to segregate that and put it in a separate column. And those invoices raised by the company, which are not yet due as on 31st of March, that also needs to be added in a separate column. And then the whole should match with whatever has been appeared in the balance sheet. So again, if due date is not specified or is not agreed, then disclosure as per the transaction date, like we discussed for trade payables, the same applies over here also. And the transaction date would be the date on which the liability is recognized as per the applicable accounting standards. Dispute, again, what we discussed, it's not necessary that there has to be a legal dispute or something in the court of law. If it is demonstrated by some positive evidence which supports a dispute by either of the parties that there is a disagreement, then that would be a dispute, and you need to show it in the line item whether it is a dispute or not. So friends, this is one additional input from my side, what I felt when I was preparing this, that we are presently giving a disclosure under the trade receivables. So like we said, secured, unsecured, considered good, we are giving doubtful, then we are giving provision for doubtful debts. Now we are also having this additional disclosure, which is required by the amended Schedule 3. So we need to ensure that the corresponding amounts, they match. So what I felt was that undisputed trade receivables and disputed trade receivables considered good. So if you go back, here there are 2 separate line items with respect to considered good, disputed, undisputed. So the total of those 2, in my opinion, should match with the total of secured considered good and unsecured considered good, which has been given in a separate disclosure, a separate table. So that should match. Similarly, then undisputed having increase in credit risk, significant increase in credit risk, and disputed having significant increase in credit risk should match with the doubtful or the significant increase in credit risk, which we are giving in the earlier classification. And credit impaired, where we are doing a provision for doubtful debt, whether disputed or undisputed, that total of those 2 should match with the allowance for doubtful debts and the credit impaired. So this internal reconciliation also, I would say internal matching, not just a reconciliation, internal matching between 2 tables, also we need to ensure that that is done properly. Some other changes in the balance sheet, friends. One is a very important change, that where the company has not used the borrowings from banks and financial institutions for the specific purpose for which it was taken at the balance sheet date, then the company shall disclose the details for which they have been used, where they have been used. So let us say many times we have seen that yesterday was 31st of March. The banks are also, they want to ensure that they show a very healthy advances for their branches and all. And therefore they ask the many of the companies that you please take this money, which you were supposed to, especially when we talk of term loans, they do the disbursements and all those things. Now, if they are not used, so definitely they would not be used by the company immediately. For whatever purposes it was granted, it might be lying there as a bank balance, or they might put it as a fixed deposit somewhere. And nowadays, we have seen corporates or companies also going for some short-term investments with respect to the mutual funds. So, mutual funds or bonds, they might put some of these amounts as at the cutoff date. Then in all such cases, where the borrowings are not used for the purposes for which they were taken from the banks on financial statements as at the balance sheet date, then you have to disclose, or I would say the company has to disclose that where they have been used. Now, let us say subsequent to the balance sheet date, on the 5th of April or 10th of April, the companies have actually made use of the amounts for which the borrowings were taken. Then also they can add by way of an additional note, but as at the balance sheet date, you see the reporting requirement is as at balance sheet date, and therefore if it has not been used as at balance sheet date, that reporting would come. So what I'm trying to say that subsequently, if it has been used for the purpose for which it was borrowed, would not be a justification for not giving the disclosure as at the balance sheet date. That would still come. If the company wants, they can add an additional paragraph or an additional disclosure that subsequent to the balance sheet date, it has been used for the purposes for which the borrowings was taken. Specified banking notes disclosure had been inserted at that point in time during the time of demonetization. So now no longer required. So that has been deleted. And in the division 1, friends, there is this requirement that whether the board, in the opinion of the board, whatever are the assets, property, plant, equipment, intangible assets, and the non-current assets, typically the long-term assets, if they do not have a value on realization in the ordinary course of business, then that shall be stated. So if whatever are the carrying amounts, if the company or in the opinion of the board, they are not able to realize the value of those assets in the ordinary course of business, that has to be disclosed. So till now, the disclosure was only with respect to property, plant, equipment, and non-current investments. By way of this amendment, intangible assets has been added. So normally you will find in the notes, in the last 4 or 5 notes, that this item comes, that in the opinion of the board, the property, plant, equipment, non-current investments, they have a value which is stated in the balance sheet, something like this. So please add the word intangible assets to that, and also check that the management, in the opinion of the board, they would be realized. Valuation by the registered valuer. So this is a disclosure requirement, again applicable to all the divisions, division 1 to 3, but in different contexts. So as far as division 1 is concerned, where typically property, plant, and equipment, if there is a revaluation that has been done upward or downward, then the company has to disclose whether it has been done by the registered valuer as defined under the company's registered valuers and valuation rules 2017. So you must be aware that even the RVO, the registered valuer organization under the ICI, all those who are members of the RVO, they are eligible to give the revaluation. So they are, I would say, valuers as per the valuation rules. So for division 1, property, plant, equipment, for the Ind AS, as you are aware that there are many other provisions also which require revaluation or fair valuation. In that case, in case of intangible assets, property, plant, equipment, definitely, including the right to use assets, as well as investment property, that disclosure of the fair value has to be made at the in the financial statement. So even if it is carried at cost, investment property, Ind AS requires to be to disclose the fair value of such investment property. So in each of these cases, whether the valuation has been done by the registered valuer as defined under 2 of the valuation rules or not, that has to be disclosed. Title of immovable properties. So friends, this is a disclosure whether the immovable properties held in the company, or I would say accounted in the books of account of the company, are held in the name of the company or not. Other than the properties where companies are lazy and the lease agreements are duly executed in favor of the lessee, right? So this is an exception. Otherwise, for all the immovable properties, wherever they might be disclosed, either as a property, plant, equipment, or as investment property, or non-current assets held for sale, or anywhere else also, if there is any such item of immovable property, then you have to check that whether they are held in the name of the company or not, and where such immovable property is held jointly with others. So the company is the first holder and somebody else, some director or shareholder is a joint holder or any such thing, then with respect to the details are to be given with respect to the company's share. So that is what is the requirement of the disclosure. So what are the disclosures to be made with respect to such immovable property, be it land or building? The gross carrying amount, title deeds held in the name of. So you have to give the name in whose name the immovable property title deeds are held, whether that title deed holder is a promoter, director, relative of promoter, director, or employee of the promoter, director. So definition of promoter we have seen earlier under section 269. So many times, there are companies where they might have properties owned by the or purchased by the director or the promoter, and then they sell off the property to the company. Company makes payment for that, but maybe for some other purposes, or maybe for the stamp duty purposes, the property is not transferred in the name of the company, and these are typically closely held private companies and all. But now all these things would be required to be reported by the company as part of Schedule 3 disclosures. Whether the name of the title holder and the relation of the title holder with the company, and since which date the property is held in the name of the title holder, I would say the non-company title holder. And if there are disputes, then you have to give the reasons. If there is a dispute also, and even otherwise also, that what are the reasons for not being held in the name of the company, also indicate if in dispute. So these are the disclosures which are required now, additional disclosures with respect to title of immovable properties under Schedule 3 and for all the division of Schedule 3. Loans or advances. Again, some extremely important disclosure requirements that have been incorporated by way of the notification. So till now, we used to give the disclosure requirements. So these are where loans and advances has been given, which are lying as a debit balance in the balance sheet or the financials of the company. So we used to give with respect to directors, we used to give with respect to the KMPs, and also related parties. Now they have added the promoter. And we used to give loan or advance, and now if you see, the disclosure is the amount of loan or advance in the nature of loan. So not purely advance, but advance in the nature of loan also. So let us say typically a situation where the company enters into transactions of purchase of some raw material with a related party for which it has given an advance. Now, till now, we always used to say that this is advance in the ordinary course of business, and therefore that was not being disclosed by the company under the specific disclosure of advances to the related parties. Now, this also classifies advance in the nature of loan. So with respect to the transaction, let us say the purchase is to be made of, I'm putting hypothetical numbers, of 2 crores. Now the advance that has been given to the related party is 1.5 crores, right? So what the auditor would need to examine is whether this is actually a loan or actually only an advance. So what the guidance note says is that you have to see that whether it is at arm's length, first of all, that if you had made a purchase from other than a related party, then whether against a 2 crore of purchase, you would have given a 1.5 crore of advance. So it would depend on the amount of the advance, also the period. Now, if the material is to be delivered, let us say a purchase order is entered today for which delivery is to be given sometime in July, and the advance has been given in April, then whether it would be in the nature of loan or it is actually an advance which would have been given to anybody else also. So the company will have to examine these issues, that whether an advance is in the nature of loan or it is a pure advance based on the facts and circumstances of each case. And if it is advance in the nature of loan, it has to be classified as such. And also such loans and advances as a percentage of the total loans and advance in the nature of loan. So the company might have given the advances or loans to third parties, non-related parties, or none of the four that have been categorized over here. So what is the percentage of the loans and advances to the promoter, directors, KMPs, related parties as a percentage of the loans and advances in totality? So, this would give up a significant disclosure in terms of amount, value, as well as in percentage terms for the stakeholders who are going to go through and read the financial statements. So the relationship has to be considered on the date of loan. Let us say a loan has been given to a director on 1st of January 2022. At that time, that person was a director. As on 31st of March, that person is no longer a director. He has resigned from his directorship. Just because the person as on 31st March is not a director, that does not preclude the company or give it any benefit of not disclosing this amount, because we have to see the relationship at the time of giving the loan or the advance. The amount disclosure should be the gross value. So if there are any impairment provisions done, we have to ignore that, and the gross amount has to be disclosed. CWIP aging, capital work in progress. So I don't think this would have a significant impact on the small companies which are into trading, which are into services. They would not have much of a capital work in progress. But yes, for large companies, especially the public sector companies, the manufacturing companies, the large listed companies, even private companies having manufacturing facilities and which are into an expansion mode, this would be of an impact. This disclosure would definitely be of an impact. So if you see, the disclosure requirements are into two categories: projects in progress and projects temporarily submitted. And the amount of CWIP for a period of, again, you have the buckets, 4 buckets given, less than 1 year, 1 to 2, 2 to 3, and more than 3 years. So first, important, the total of this should match with the total of CWIP that is being disclosed on the financial statements, the balance sheet. Right. Second is that the disclosure is not to be given at the project level. So if you have, let us say, 5 factories which are forming part of the CWIP, you have some new factories, the client has some new factories being constructed, some additions being done to the existing factories which are still as on 31st March as CWIP, then you do not have to give the project-wise or the factory-wise details. You have to give totality, projects in progress, and the amount as per the aging schedule. Disclosure will also be made for investment properties which are under development. And so you have CWIP as well as the investment property under development. So the aging you will have to determine from the initial recognition to the date of the balance sheet. So let us say there is a big factory that is being built for which the initial recognition of CWIP was made sometime 2 years back. And then as on 30, so let us say sometime in 31st March 2020. And now we are going to close 31st March 2022. So we will have to categorize into buckets from the date. So whatever is the amount that has been spent in the 2 years back with respect to that project, that would come as an amount of CWIP for a period of 2 years, or I would say 2 to 3 years, because it is more than 2 years. So for a single asset project, the aging for the total amount may be falling into different aging buckets as a particular date. So you might have different projects. So you have a single project which is then into different dates that the payments are being done for the CWIP, and then that would be classified into those buckets as per the aging analysis. And for temporarily suspended and in progress, you have to see the status as at the balance sheet date at each reporting date. Any change in status during or after, that would not change the classification with respect to whether it is in progress or temporarily suspended. Let us say a project was temporarily suspended for some reason, maybe because of some waterlogging or some legal disputes or whatever it might be. But as on 31st of March, it has started work. The work has started. It is now in progress. Therefore, irrespective of that being temporarily suspended for a few months during 21-22, as on 22 ending, it would be classified as projects in progress. And similarly, projects temporarily suspended, let us say as on 31st of March, but in April or May, they start functioning, the capitalization starts, the work on that project starts. But since as on 31st of March, it is temporarily suspended, it will have to be disclosed as such. So now you have the completion schedule, CWIP completion schedule. So that was what we saw first was the aging schedule. Now you have the completion schedule. So aging would be with respect to back whatever has been completed, and completion is with respect to the futuristic. So your details have to be given project wise. That is one. Second is that these details are to be given for those projects which are overdue in terms of time and exceeded costs. I would say overdue in terms of time as well as cost. So if there are such projects, then these details have to be given on the completion schedule. The guidance note says that we should give two separate tables. One where there is overdue on account of time, and the second table should consist of details, project-wise details for that which is overdue because of the cost, or I would say cost overruns. And over here, project-wise details have to be given. If you remember in the previous slide, we said that we have to give in totality, project-wise is not required, but over here in this disclosure, project-wise details have to be given. So the original plan becomes very important. See, friends, many times we have seen in case of our clients that, and especially, in the last 2 years because of COVID, there would always be, I would say not always, but in majority of the cases, there would be time overruns that would have happened because of the lockdowns and all. And so you have to see what is the original date that, and whether that can be considered, or subsequent to that, the plans are revisited and revised, right? If they are revisited and revised, you should consider that only if they are in the nature of a fresh original plan. Otherwise, see what happens, we would have seen that every time, let us say 31st March 21 is the original plan date, it is not completed, and then the project team says, okay, now 31st March 21, we will now revise it to June 21. Then it is not completed, again they would say, fine, it is now again revised to March 22. So in such case, these revisions should not be considered because they are actually variations which are being considered or taken care of. Unless actually the original plan itself gets revised with respect to the completion date, then only you should consider it. Details of projects where activity has been suspended shall be separately given. And in case there are small amounts which are as projects, then that can be clubbed and given as a single line item. If there are too many projects, too many line items to be given, then the guidance note gives the option that based on materiality, individual items can be aggregated. Friends, similar disclosures what we had for CWIP aging and CWIP completion schedule, the same disclosure, similar disclosures are required for intangible assets under development. So these are typically CWIP for intangibles, and the same two disclosures with respect to the aging of the intangible assets under development and with respect to the time overruns and the cost overruns with respect to the intangible assets under development are also required to be disclosed. Benami property. This is a new disclosure which has come into the, I would say, Schedule 3. So where any proceedings have been initiated or pending against the company for holding any Benami property. So if the company is holding any Benami property and proceedings have been initiated or are pending, then the disclosures shall be made. So the first set of disclosures is with respect to the details of the property, the year of acquisition, the amount, and the details of the beneficiaries, because these are Benami properties which are which the company is holding, which means there are the beneficiary is somebody else, and the details of the beneficiaries and the relationship of the beneficiary with the company would have to be disclosed. In the books of account, whether the property, if the property is in the books, then you have to give, or the company has to disclose the reference to the item in the balance sheet, that in the balance sheet under which category, whether it has been shown as an advance or it is under property, plant, equipment, where this property is reflected in the books. And if it is not there in the books, then the fact shall be stated with the reasons that why it is not there in the books, though the property is in the name of the company, but it is not in the books. That those details shall be disclosed. As an auditor, friends, I would say that one is about initiating the proceedings and all. Second is on scrutiny of the rates and taxes ledgers and some the utility related invoices. Let us say there is a water tax or electricity bills, the corporation tax, the land revenues, any such taxes or things are being paid in the by the company from the books of the company. Then you have to check, I would feel, the assets, the FA register, whether those assets are there in the books or not. If yes, then it's fine, because this would also be, if you remember, we had discussed earlier the title of immovable properties, where the assets are in the books of the company, but the title deeds of the immovable property is not in the company's name. That disclosure would have to be done. So even for that, this procedure for audit would be required to be done. And the third set of disclosures under Benami property is where the company is acting, whether the company is acting as an abettor or a transferor. Then you have to give details like who is the initiating officer at the date of show cause notice, and the nature of proceedings also, whether it involves any attachment or adjudication, and the status and what is the company's view with respect to the proceedings that are going on. So these are the disclosures with respect to Benami property that are required in Schedule 3. Borrowings on the basis of current assets, security of current assets. So these are typically like we have the working capital loans, the overdrafts, the cash credits, where the security is current assets. Inventory is trade receivables, where then the quarterly returns or statements are filed by the company to the lender, to the bank or the financial institution. Then the company has to report that whether these are in agreement with the books or not. So whatever are the quarterly statements that are filed, whether they are in agreement with the books or not. If not, what are the reconciliation and the reasons of the discrepancies have to be disclosed in Schedule 3 by the company. So friends, over here, what I believe the first thing that we need to tell our clients or the companies to educate them, that the quarterly, see, as far as trade receivables is concerned, you would always have a details of the trade receivables, and it would be easy to match the quarter end returns or the statements that are filed. But the challenge would come with respect to inventories, where the inventory valuation is not forming part of the books of account or is not included in the system, the accounting system, on a quarterly basis. So I believe that is the first thing, because let us say the company gives a statement that all the quarterly statements are matching, but as an auditor, whether they are in agreement with the books or not, how would you identify, how would you be able to assure, unless those entries or those amounts are found in the books, then only you would be able to do it. And therefore it becomes important that on a quarterly basis, these amounts are made available to you as an auditor in the books. So the borrowings, if it is at any point in time of the year, so let us say the company has taken some borrowings in the month of October, and by February end, it is a current, so borrowing on the security of, so that is the precondition, and by Feb end, it has paid away those borrowings. Then also the disclosure is required that whether at the quarter end, let us say December end, those statements that were filed, whether they are in agreement with the books or not. So it's not necessary that it has to be outstanding as at the end of the year. And the disclosure is required even where there are sanctioned borrowings, even if the amounts are unutilized. So as far as the borrowings are sanctioned during the year, be it funded, non-funded, whatever it is, this disclosure would be required. In certain cases where there are large borrowings, maybe a monthly statement is required, but what the requirement, the Schedule 3 requires to be reported is that on a quarterly basis. So you have to verify is only the quarterly returns and the quarterly statements only. The illustrative format has been given in the guidance note. I have not included over here. And this disclosure would also be required in case borrowings have been availed on based on the security of current assets of other companies. So in that case also, this disclosure would be required to be made by the borrowing company. Willful defaulter disclosure, where the company is declared as a willful defaulter by a bank or financial institution or other lender. We know the Reserve Bank of India has given the details of who can be declared as a willful defaulter. And if the company has been declared as such, then the date of declaration and the details of the defaults have to be disclosed. The lender term, it covers all bank financial institution to which amount is due as per the RBI, and events up to the date of approval of financial statements should be considered for disclosure. That is, when they are adopted, when the financial statements are adopted in the board meeting, till that date, all the details should be. So let us say as on 31st of March, the company is not declared a willful defaulter, but post March, but before the sign off of the financials, before they are adopted, before they are approved, the company is declared as a willful defaulter, then this disclosure would have to be made even in the 31st March 22 financials. Relationship with struck-off companies. This is an extremely challenging area, friends. I'll give you the background and then I'll say why this is challenging. So over here, what the company is required to disclose is whatever balances it has with a company, a receivable balance or a payable balance as a security. So if the company has invested in a security of a company which is struck off, or the company has an investment of, that means as a shareholder, the company has a shareholder which is a company which is struck off, then these disclosures are required. And these are disclosures required even if there are transactions during the year with such struck off companies. Now the challenges, I'll say 2-3 challenges. First challenge is that in most of the companies, the CIN is not available at a single point. So you have a trade receivables, because see, this is all balances. So even a trade loans and advance, all balances, wherever there are company entities, this exercise would have to be done, and it would have to be done at the end of each year, right? So first is to have a database, to have a master file with the company for all the CIN that the company would have as its balance outstanding or transactions done with that other entity, which is a company. Second is that at the MCA, I have been discussing with Sri Priya madam, and she is interacting with the MCA from the CLCGC, that presently, if you look at it, there is no single database on the MCA which is available where the full list of struck off companies, let us say as at 31st March 22, is available. What the guidance note says that we do have the STK 7 under section 248 of the Act, but when you visit the MCA site, you will find that the STK 7 is filed by each ROC each month, right? So you might find that for the month of Feb, there would be 20 STK 7 filed by each ROC, giving the list of the companies which that ROC would have struck off. Then similarly, you would have for Jan, you would have for March, but there is no single database where you can do a VLOOKUP for such struck off balances or such struck off companies. So in a simple way would be that one, at the company's end, at the client's end, there is a full database with the CIN, and at the MCA, there is a full database of struck off companies with the CIN. You just VLOOKUP, you just map the two, and you find out that in case of your client, how many are the companies with which they have transactions with or balance with which have been struck off, and then this disclosure becomes easy. So this would be a challenge presently, and going forward, I hope that there would be some solution that would be available. But yes, friends, this is a disclosure requirement, and predominantly to understand that what are the balances, and I would not be surprised, if all these are given made part, all these disclosures are made part of the ROC return, the annual return that the companies file, by which the data extraction for the government becomes very easy, and they would be able to populate and find out maybe for the stock of companies that what are the balances lying outstanding with other companies, investments, whatever it might be. And so these are the for this particular point, especially I feel there is an additional challenge that is there. Some other disclosures: charges satisfaction yet to be registered with the registrar of companies beyond the statutory period, along with the details and reasons thereof. So with respect to creation of charge and the satisfaction of charge, if the compliance period, the statutory period has lapsed and the company has not complied with it, then that disclosure has to be given. Again, under 287 of the Companies Act, there is the Act prescribes that a company can have a maximum 2 layers of companies under them, that is by way of a subsidiary or such. So now the disclosure is required that where the number of layers prescribed under 287 has been violated, then the name and the SIN of such layer of companies along with relationship and extent of holding has to be given. So in many groups, I would say, we have seen that there is actually a web of companies. In such cases, the companies will, auditor would also have to examine that whether there is a violation of section 287, and if yes, whether the company has disclosed the name and the layer of companies and the extent of holding in such cases. Disclosure of analytical ratios. Friends, I feel that analytical ratios we always used to compute for the compliance of the standards on auditing also. But now the analytical ratios are to be made forming part of the financial statement disclosures by the company and duly verified by the auditors. So if you can see, there are 11 ratios for the division 1 and division 2 companies, and as far as division 3, which are NBFCs, there are 4 categories of ratios or 4 ratios that are required to be disclosed. So again, taking cue from what the guidance note says. So I will not go into the details of how the ratios are to be worked out. They are given in the guidance note. It's been very nicely prepared by the CLCTC. So all the details, I would request you can go to the guidance note and verify the computation mechanism or what are the different ratios, how they are to be calculated. But what it says is that whatever are the items you consider as a numerator and denominator. So let us say current ratio, you have some elements on the as the numerator, you have some elements as the denominator. But on a year-on-year, because you have to give comparatives for March 22 as well as March 21, and maybe going forward also, but you have to ensure that the items, the elements in each of the ratio, they should remain same. There should not be any change. Now, let us say for any reason in the current year, March 22, you feel, or March 22 would not be an issue because March 21 also the company would be computing presently in a real-time basis, but something you have disclosed in March 22, going forward March 23, you feel that it needs some change in the numerator or the denominator, then that change, when you are doing the March 23 financials, the same change you will have to bring about in the comparatives, the March 22 ratios that you are doing, and you will have to restate those ratios. So it would not be that, I have already certified in March 22, I cannot change, but the guidance note says that wherever there is a change in the current year, corresponding changes have to be, and corresponding recalculation also would have to be done as far as the previous year number is concerned. There has to be a consistency because then only the ratio comparison would make sense. So this is a format that has been given, that for a current ratio, what are the elements in the numerator, what are the in the denominator, what is the current period ratio, what is the previous period ratio, percentage of variance. Now the schedule 3 requires that where the variance is more than 25% as compared to the ratio of preceding year, then the company has to disclose the reasons for the variance. Now, friends, 25% might look significantly high, but when we talk of ratio, let us say something like a debt equity ratio, right? Last year, it was the debt equity ratio was 1, and now it is 1.3 in the current year. So you see, on a year-on-year basis, there is a variance of 30%. And then the reasons for such variance has to be given. So that this has to be followed for all the categories of ratio, and this is the format that has been suggested, and for which the disclosure we have to do in this format. Like I said, Annexure B to the guidance note, it gives the examples of the analytical ratios that are to be given. Schemes of arrangement. So wherever there is any scheme of arrangement that has been approved by the competent authority, now mostly it is the NCLT, then the company will have to disclose whether the accounting entries in the books of account are in accordance with the scheme and also in accordance with the applicable accounting standards or not. And if there is any deviation, it has to be explained. I feel nowadays the NCLT, when the scheme is filed itself, a certificate from the statutory auditor is obtained that the accounting treatment that is proposed in the proposed scheme is in line with the accounting standards, and then that goes with the application to the NCLT. So not much disclosure, I feel, might be required under this, but still this is a requirement, and therefore it has to be validated that whether the there is the accounting is in line with the scheme as well as the accounting standards or not. Utilization of funds and share premium. Friends, again, a very interesting disclosure as well as very challenging from an audit perspective also. I will give you the gist of whatever is mentioned over here. What it says is that whether a pass-through entity is being used for funding, either inflow or outflow. For example, let us say there is an entity A, and entity A gives to entity B with the instruction or guidance or inclination that that money entity B will give to entity C. So A does not give directly to C, A gives to B, B gives to C. And similarly, it might be reverse also, that where C, our client, has to give money to somebody, it does not give directly, it uses a round trip or it uses a pass-through entity in such case also. So this disclosure, if you see that where a company has advanced, loan, invested, so even an investment, right? So many times, especially in case of foreign investments, we have seen that the entity in India, it already has a subsidiary outside India, so it gives money to or invests in that subsidiary outside India. That subsidiary outside India in turn invests in another subsidiary. So A directly does not invest into that, it goes through another subsidiary. So where a company has advanced, loan, invested to any other person or entity, including foreign entities, with the understanding that the intermediary shall lend or invest in the ultimate beneficiaries or provide guarantee security on behalf of the ultimate securities, or where it has received. So the first portion was about advancing, second was where it has received from any other person. Then the company through a round trip mechanism, then there are a lot of disclosures which are to be made about the date and the amount of fund advanced or loan, the amount of fund further advanced and loan, date and amount of the guarantee, security, etc. provided, and very important, declaration. So the company has to give a declaration that provisions of FEMA and the Companies Act are complied and transactions do not violate the Prevention of Money Laundering Act. So this declaration also will form part of the disclosure. So friends, this disclosure is not only required for transactions that have been done during 21-22, but also those amounts which are outstanding as on 1/4/21 and were subsequently utilized as on 1/4 or subsequently as during 21-22. So whatever are the during the year transactions as well as opening balance, that all those, if it is a round trip or a pass through, then this disclosure along with the declaration has to be given in the Schedule 3 financials. On the profit and loss side, on the face of P&L, total revenue has now been changed to total income. And in respect of the income from operations, we have a lot of Section 8 companies now doing CSR activities. And for such companies, under the operating income, the line item has been included, grants or donation received. So this would be relevant typically in case of a Section 8 company, but till now there was no separate line item. Now a separate line item has been given. Disclosure of undisclosed income. I know that might sound like a rhyme, but yes, that is what it is. Disclosure of undisclosed income. So this is again where the transactions are not recorded in the books of account, but has been surrendered or disclosed as income during the year in the tax assessment. So very important, friends, over here is that whatever the company has surrendered or disclosed as part of the tax assessments, only such disclosures would form part of undisclosed income. So typically not that where the assessing officer has made some additions of its own, or the company says that just to buy peace, fine, this expense you disallow, I am okay with it. And so such things where it has been, where the company surrenders or disclosed as income, only such cases the disclosure would come. And so if you see the third bullet, the word surrender or disclose implies that the companies must have voluntarily admitted to addition of such income. And in case there is a statement that has been made during the course of search, survey proceedings, which has thereafter been retracted, then in such case also this disclosure, it cannot be considered as a surrender of income, and therefore no disclosure is required. Now, where there is such an element of a surrendered or a disclosed income, then the company shall state whether the previous unrecorded income and related assets have been properly recorded in the books of account, and if yes, then where have they been recorded in the books of account. This is the disclosure that is required under this. CSR under section 135. So we have the guidance note on CSR where some disclosures had been required, but in addition to that, there are more disclosures that have been added and now included as part of the Schedule 3 disclosures. So with respect to CSR activities, the amount required to be spent, amount spent or expenditure incurred, shortfall, previous year's shortfall, reason for shortfall, nature of CSR activities, details of related party transactions, and where a provision is made with respect to a liability incurred by entering into a contractual obligation, the movement in provisions should be shown separately. So whatever is the opening against and whatever has been utilized, reversed, what is the fresh provision that has been created for such contractual obligation, and so that whole movement will have to be now disclosed. Cryptocurrency, virtual currency. So we already had in this budget, we know that from today, 1st April, the gains on cryptocurrency, virtual currency are subjected to income tax. But this was already included as a part of disclosure, like I said, a year back when the notification was announced on 24th of March 21. So the disclosures that have to be made with respect to cryptocurrency or virtual currency are the profit and loss of transactions on such currencies, the amount of currency held as at the reporting date as at 31st of March, deposits or advances from any persons for the purpose of trading. So if there is any advance, there is any deposit, some security deposit that has been given for the purpose of investing, then that also, that amount has to be disclosed by way of course that what is the amount under advance to for crypto or virtual currency transactions. So friends, if you see all these disclosures, we would have to give comparatives. I hope now by now you would have realized why the CLCGC insisted on this webinar. And like I mentioned in the morning, it was just to create awareness that what are the transactions, what are the disclosures. There are some very, very difficult disclosures: trade receivables aging, trade payables aging, CWIP aging, a lot of things with respect to immovable property, a lot of disclosures. And for all that, we will have to have the comparative for March 21 also. And therefore, it becomes imperative for us, I would say extremely important, that we start educating our client that this is what is required. Please start. Otherwise, the March 22 financials to close with these disclosures would be extremely difficult. So with that, friends, now we move to the other leg of our presentation, that is on CARO 2020. Let me relax you a bit that it would not be as tough as the earlier, because many of the provisions in CARO 2020 we would have already discussed as part of our Schedule 3 discussion, and that I would just skip for the present, and we would focus on whatever are the new or additional disclosures which are specifically required by the CARO 2020. Yeah. So friends, like I said, as the name suggests, 2020, it was 2 years back that this CARO notification was issued, but then it was amended, it was postponed 2 times, and now it is applicable for definitely March 22 year-end financial statements that we would be closing. The guidance note on CARO 2020 issued by the AASB is there in public domain, and I would request you to please download that along with the guidance notes on the Schedule 3, Division 1, Division 2, Division 3, and please go through them well in advance so that you are equipped that when the CARO reporting comes, you are ready to go through it and report as per the requirements of the guidance. So the exemption to the CARO continues whatever it was. There is no change in the exemption with respect to banking, insurance companies, Section 8 companies, OPC, the small companies and private companies where there are specific conditions to be satisfied. So friends, what I have done over here is I have done a comparative analysis. So it becomes easy for us to understand what are the changes and where are the changes. So if those in the blue are the changes that we have already discussed under Schedule 3. And those in the red are the ones where we would cover those as part of the CARO changes, and they were not there in the Schedule 3 change. So we'll avoid the blue ones because I feel we'll end in the next 15-20 minutes, and we have another 10-15 minutes for the question answers in case there are any questions from the participants. So intangible assets. So right now we used to report on the property, plant and equipment, the fixed assets register, as we used to say, and we used to report on whether the company is maintaining proper records, including full particulars, the quantitative details, and the location situation of the PP. Now, with respect to records for the intangible assets, also the company has to maintain the records. So let us say the company has invested into the softwares, which it has shown as intangible assets, then the company will have to mention in the register of intangible assets that whatever is the software license number, from where they have obtained, when is the date of they have obtained, the amortization schedule, the amortized value, let us say into which computer or equipment or a laptop that it has been installed, the location, and when is it expiring or when are the renewals. So the whole intangibles register will now have to be maintained by the company, which as an auditor we are required to report whether the company is maintaining proper records showing full particulars of intangible assets. Title deeds of immovable properties we've already covered under Schedule 3, and therefore I will skip it for CARO. Revaluation of property, plant, equipment, whether it has been done by the registered value or not, we discussed that under Schedule 3. Benami transactions, whether any proceedings have been initiated, this is now also, see, friends, important to understand that this reporting, though done under Schedule 3, is also to be reported by the auditors under CARO. So this, whatever we report under CARO becomes our responsibility. We would not be able to say only that the company has reported under Schedule 3, so I have reported here. As an auditor, we will have to carry out our diligence, our activities, our audit procedures, our audit documentation, because it is forming part of CARO also. Inventory verification. Again, I would say a small change, but a significant change. Earlier, the CARO required that whether there are material discrepancies that were noticed, and if so, whether they have been properly dealt with in the books of account. Now that material word has been removed, and instead a 10% threshold has been mentioned. It has now been notified a 10%. So as an auditor, you have to opine on the coverage and procedure of the verification by the management, and whether any discrepancies of 10% or more in the aggregate for each class of inventory. So each class of inventory, friends, would be, let us say raw materials is a class of inventory, packing materials is a class of inventory, WIP is a class of inventory, FG, stock in trade, goods in transit, these are all different classes of inventory, and under each class of inventory, if in the total, in the aggregate, the variance is 10% or more, in such case, you will have to, as an auditor, report whether they have been properly dealt with in the books of account or not. The second point is with respect to working capital limits sanctioned on the basis of the security of current assets. Just one small deviation over here. As far as Schedule 3 was concerned, there was no threshold limit. As far as CARO is concerned, they have given a threshold limit in excess of 5 crore rupees. But that is the sanctioned amount, not the outstanding amount, friends. So where the working capital limits, which are secured by current assets, sanctioned are in excess of 5 crore rupees, then only CARO reporting is required. But as far as Schedule 3 is concerned, there is no threshold. So even if it is of 1 crore rupees, it will be required. Investments, guarantees, securities, advances in the nature of loan. Again, a major change. If we see on the left, CARO 2016, it covered only for the parties maintained in the registered under 189. So typically what we say are the related parties. Any advances, loans, or secured, unsecured that were given to firms, companies, LLPs, which were covered under 189, only those were to be disclosed. Now that reference to 189 has been removed, which means any loans, investments, guarantees, securities given to any party, whether related or not, will have to be disclosed over here. So if we look at the CARO 2020 requirement, whether during the year the company has made investment, guarantee, security, or advances in the nature of loans. I hope you recollect the discussion we had with respect to advances in the nature of loans. We were discussing under Schedule 3, secured or unsecured. Then the disclosure requirements are that whose principal business, so it is not applicable to those entities whose principal business is to give loans and all. Then we have to give the aggregate amount during the year, balance outstanding as at the balance sheet date with respect to such loans. So there are two categories. So one is with respect to balance outstanding in respect of the subsidiaries, JVs and associates, loans and advances which are given. And second is with respect to entities which are other than the subsidiaries, joint venture and associates. So that is the first disclosure requirement under this. The second is that whether the investments and all are not, the terms and conditions are not prejudicial to the company's interest. Earlier we used to give is only grant of such loans are not prejudicial. Now investments also. So it would be a big challenge where the company has made an investment, that company is into losses, right? They have accumulated losses, or the company has given a loan where that entity is into losses. It might be a joint venture associates. Then we will have to give a justification, or at least document the justification how it is prejudicial or not prejudicial to the company's interest. Then with respect to the schedule of repayment of principal, whether it is loans and advances in the nature of loans, the 3D is similar to what it was earlier reporting, where the total amount was overdue for more than 90 days, because these are all receivables. Then where it is overdue for 90 days, whether the company has taken reasonable steps for its recovery. Additional reporting requirements. So this red, you remember, is something which is not covered under Schedule 3, but it is our responsibility under CARO. So where any loans or advance has fallen due, then whether the company has renewed or extended or fresh loans granted. So let us say the company has given loan to somebody which was falling due on 1st March 22. That party is not able to repay that amount to the company, and therefore the company has renewed it. It said fine, 1st March 22. Now you give on, I reschedule it, you give on, let us say 1st September 22. So it has extended, it has just renewed that. In that case also, this reporting is now required under CARO, that with respect to the renewal or extension, that what is the amount of such dues which are renewed or extended, or maybe the company has given that amount, a fresh loan to that party, by which that amount, that party has cleared the original loan. So it is a fresh loan granted to settle the overdue amount. And then all these details has to be given, and also the percentage of the aggregate to the total loans or advances in the nature of loans granted. So this is a additional reporting requirement under CARO 2020. 3F, if you see, whether the company has granted any loans or advances in the nature of loans, either payable on demand or without specifying any terms or period of repayment. And if so, you have to give the details, the total amount, percentage therefore to the total amount granted to the promoters, related parties as defined under 276 to the Companies Act. So friends, these are the additional reporting requirement under the loans and advances that are granted. So loans, advances, investments, securities, guarantees, or I would say advances in the nature of loans. Under clause 7, the GST, the goods and services tax, has been added now in the list. And 7B, if you remember earlier, there was always an inconsistency between 7A and 7B. So now they have removed the references of different laws under 7B, and they have given a cross reference of 7A, that whatever are the 7A that you are mentioning as the disputed dues, if there are any undisputed dues, then that also you mentioned. So they have linked the two. So 7A is the undisputed dues and 7B is the disputed dues. 8, this is what we have discussed about the undisclosed income to be made. The disclosure is to be made in Schedule 3. And though already made in Schedule 3, again, as auditors, we have to comment on it under CARO 2020. Default in payment of loans or advances. So here earlier it was with respect to financial institution, bank, government, dues to debenture holders. Now if you see that where the company has defaulted repayment of loans or other borrowings in the or the repayment of interest to any lender. So earlier it was restricted, now it is with respect to any lender, even if it is NBFC, which was not covered earlier, or any private loans also, then this disclosure would be required as per the format below. The nature of borrowing, including debt securities, what is the nature of borrowing, name of the lender, and in case the lenders are banks, financial institutions, and government, then lender-wise details is to be provided. Amount not paid on due date, whether it is principal which is not paid or interest which is not paid, number of days of delay or unpaid remarks. So all these disclosures have to be made with respect to any lender where default has been made. 9B, willful defaulter, we already discussed under Schedule 3, and that has to be reported under CARO. 9C, where term loans were applied, whether term loans were applied for the purpose for which the loans were obtained, if not, the amount of loans so diverted and the purpose for which it is used may be reported. Friends, if you remember under Schedule 3, we had a similar provision that wherever the loans have not been utilized for the purpose for which the borrowing was done as at the balance sheet date, that has to be disclosed. Here it is specific with respect to term loans. There under Schedule 3, there was no specifications of term loans. It could have been any loans, but here it is with respect to term loans. And if not, the loans so diverted and the purpose. So normally we have seen that in case of term loans, the payments are made directly by the banks or the lending institution to the vendors. This is the normal practice we have seen, and therefore in such cases diversion might not be there. But we have also seen cases where the amount is paid to the company, and in turn the company pays to the contractor or the vendor for the purposes or the construction or the capex. And in such case, this reporting would be relevant and important. 9D, whether funds raised on short-term basis have been utilized for long-term purposes or not. If you remember, under the 2016 CARO, this was removed. It was there earlier. It was removed in 2016, and now it has been reinstated, I would say, whether funds raised on short-term basis have been used for the long-term purposes or not. So now from the financials, you will have to determine whatever is the short-term funds and whatever are the long-term liabilities. On that basis, you will have to check whether there is any mismatch. If yes, then you will have to report on it. Whether the company has taken any funds from any entity or person on account of to meet the obligations of its subsidiaries, associates, or joint ventures, then you have to give details. So let us say this company, which is your client, has borrowed money, and with that money, it has satisfied the obligations of the subsidiaries, associates, or joint venture. It is not used for its own purpose, but for the purposes of its group companies. In such cases, this disclosure would be made. And the last clause, again, we have seen a lot of frauds that have occurred, and maybe that could possibly be the reason why this has been inserted, that whether the company has raised loans on the pledge of securities held in its subsidiaries. So the company, let us say your client, the reporting company, has pledged securities of its subsidiary. So maybe the holding company is not a listed company. I'm just taking hypothetical situation. The subsidiary is a listed company. So the holding company pledges the shares of the subsidiary and takes loans or takes borrowings. So this would now be required to be disclosed as part of the CARO. IPO, whether money is received by IPO. So earlier term loans were there. If you remember, we have seen in the earlier whether funds utilized, borrowed on term loans have been utilized or not has been put as a separate clause, and therefore the term loans has been deleted from 10A, and now it talks about clarifies that it is with respect to IPO or FPO made during the year, and for which the money has been utilized or has been applied for the purpose for which it was raised. 10B, again about the private placement, preferential allotment of shares or convertible debentures, whether requirements of section 42 and section 62 have been complied and the funds raised have been utilized for the purposes. So if you see with respect to, on the liability side, if I say a balance sheet, whatever are the increase, let us say with respect to share capital, with respect to your debentures, with respect to your borrowings, long term, in all these cases, typically CARO requires that whatever are the monies raised, whether they have been utilized for the purposes for which they were raised or not, or applied for which they had been raised. Fraud, friends, again, a very, very difficult, I would say, clause now to report on. Earlier, if you see, there was a restriction that fraud on or by the company, by its officers or employees, was supposed to be reported. Now the officers or employees has been deleted, which means any fraud by the company or on the company. If you remember, there have been cases where the client has received mail from a very, very similar email ID as its vendor, saying that this is my bank account and you please pay money into this bank account, and the client pays the money, and then they realize that this is a fraud. That actually is not the vendor. There was a fraud that has taken place. So till now, because it was not by the officer or employee, it was not to be reported under CARO 16. But under CARO 20, it might necessitate to be reported, because any fraud or error or any fraud by the company or on the company is required to be reported. And then it also asks about ADT 4 under 143.12, whether the auditor has filed the form under ADT 4 disclosing the fraud to the central government, and also whether of the whistleblower. So many companies have this whistleblower cell, I would say, or team, as well as a whistleblower policy. And if the company has received any whistleblower complaint, then as an auditor, you have to see that whatever is the whistleblower complaint, and then you'll have to report also on that whether you have considered the whistleblower complaint or not, which was received during the year by the company. So these are all additional reporting requirements under CARO. Managerial remuneration has now been deleted because it forms part of the schedule. So it has been removed from here. Whether default in the payment of interest on deposits or repayment thereof for any period, and if so, details thereof. So this is about the acceptance of deposits, and whether there is any default in the payment of interest or deposits, then that has to be reported. Internal audit system commensurate with the size and nature of its business. Again, friends, if you remember, this was there earlier in CARO 16, it was removed, but now it has been reinstated. And in addition to that, so one is, yes, reporting about the internal audit, whether it is commensurate with the size and nature or not. The second is, now as an auditor, you will need to report whether the report of the internal auditors were considered by you as the statutory auditor or not. So, which means that you will have to obtain a copy of the internal audit report. You will have to go through it, and then only you will be able to report that whether you have considered. And yes, if that internal audit report contains any system failure or any adjustments which are required in the financial statements, you will have to take cognizance of that also, and you will have to verify whether the company has taken action on that, made the necessary entries or not. This is with respect to the NBFCs. So we already had a reporting requirement that whether a company is required to be registered as NBFC and whether the registration has been obtained or not. Now, in further continuation of that, the next clause that has been inserted is that whether the registration has been obtained, and then whether the company has conducted any NBFC or HFC activities without a valid certificate of registration as per the RBI Act. So an additional reporting has been now included. Then further is with respect to core investment companies, the CIC. Many of the groups, like we had mentioned earlier, they have a company whose sole purpose is to make investments within the group. So not investments outside into the money market or mutual funds and all, but investments within the group, which are known as the core investment company. And then if the company has a core investment company, then you will have to report under CARO on whether it fulfills the criteria for the CIC, and in case it is exempted or unregistered, whether it continues to fulfill such criteria. And in the next clause, you will also have to report that whether there is only one CIC, or if there is more than one CIC in the group, then you have to indicate the number of core investment companies which are part of the group. Cash losses, again, I would say this was there earlier, removed in 2016 CARO, and now it is back over here. So whether the company has incurred cash losses in the financial year and the immediately preceding financial year, it state the amount of cash losses. 18, again, a new point, friends, that where a resignation of statutory auditor has taken place, and this would be applicable to the new auditors who would be signing the CARO when the earlier auditor has resigned. So the reporting requirement is that where there has been a resignation, then whether the auditor, the signing auditor has taken into consideration the issues, objections, or corrections raised by the outgoing auditors. So one thing, first thing important as part of audit documentation is communication with the previous auditor. Even our code of ethics requires it, but now also CARO 2020 would require it, that whether you have communicated with the previous auditor, and if in that communication there are some issues, objections, or concerns that has been raised by the outgoing auditor, then whether as the signing auditor, as the statutory auditor, you have taken into consideration those issues, objections, or concerns or not. Clause 19, on the basis of financial ratios. So here what you have to opine, which is again difficult, is that no material uncertainty exists as on the date of the audit report that the company is capable of meeting its liabilities existing at the balance sheet date for the period of 1 year. So typically we saw earlier in the earlier clause, short-term funds being used for long-term purposes. That would be one criteria, one trigger point. Second is the financial ratios, the aging, the trade receivables, payables, the matrices. If you remember, we discussed in Schedule 3, your interaction with the management, information about the company. So gathering all that information as an auditor, you will have to opine that no material uncertainty exists for the company in meeting the liabilities in the next 12 months from the balance sheet date. Clause 20 about CSR 135, that with respect to the ongoing projects, where the company has transferred the unspent amount to a fund within a period of 6 months. So whether that money has been transferred to the fund or not, and second, the unspent amount, and then whether the amount remaining unspent has been transferred to the special account in compliance with the provisions of subsection 6. So first is with respect to subsection 5 with respect to the ongoing projects, and the second is with respect to subsection 6 of 135. And friends, the last clause of CARO. So CARO for consolidated financial statements is not required. So let us say a company having 4 subsidiaries. Each of the subsidiary is Indian subsidiary where CARO is there. So for the consolidated financial statements of the holding company, you need not prepare a consolidated CARO consisting of the CARO of holding company and the CARO of the 4 subsidiaries. That is not required. But what this clause requires is, if in any of the subsidiaries there is a qualification or adverse remark by that auditor of the subsidiaries, then that adverse remark or qualification you will need to report in the CARO on the standalone financial statements of the holding company, right? I hope this is clear, that you don't need a CFS CARO. CARO will only be with respect to standalone, but you will have to ensure, you will have to go through the CARO of each of the group entities, and if there is any adverse remark or qualification in the respective company, then you have to indicate the details and the para numbers of the CARO in the CARO of the standalone of the holding company. So friends, with that we come to the end of the presentation. I thank you very much for patient listening. I hope the purpose for which I was given this task to create awareness, I have been able to do justice to that. And here you can see this is my website, vishaldoshi.in, where there are a lot of Excel tools and the snippets and all that Shripriyaji was mentioning in the beginning. So friends, thank you once again. And in case there are any questions, I would be more than happy to take them. Thank you.
Yes, Vishal, thank you very, very much for a very, very complete presentation. And what I found was very nice was not only was your presentation good, but your presentation template was also very good. Very, very, very professionally done, Vishal Bhai. So thank you very much. And just a couple of small things. I think, Vishal Bhai, there are obviously a lot of questions, so which I'm going to run through. Sarika, would it be possible to extend this session by about 15-20 minutes if Vishal ji is free? Or
not a problem, ma'am.
Sure. So I just wanted to ask you one thing, Vishalji. Now, suddenly this seems to be changing audit's focus from solvency to liquidity. See, as an auditor, we were always responsible for solvency, the balance sheet, you know. But today, by asking us to comment on ratios, etc., this seems like overnight your responsibilities have significantly increased from financial reporting to management reporting to commenting on one's solvency. What is your view? Is it possible to sustain this new CARO? If so, at what cost and what fees?
Yeah, in fact, you won't believe. Since the last about a week or 10 days, our office is doing an activity which is sending the revised proposal for the audit fees for March 22 to all our company clients. At least that is what I would say. Well, I agree that there is a sea change in the whole reporting, and I would say, fortunately enough, if we look at the chronology of events, you would agree that earlier all this was just CARO, and where it would have been an onerous responsibilities on us as an auditor to report on all the changes. Fortunately, I think that a lot of the provisions have been moved into Schedule 3, by which the responsibility as far as the management is also sharing, or I think the primary responsibility becomes that of the management, and then as an auditor we verify it. But yes, I feel, but see, if you look the way the businesses are being transacted, the way valuations are happening, it is now, I would say, even if we look at the change in Ind AS, to be very honest, the historical cost is a thing of the past. That we all agree. Everybody wants that what is the valuation as on today, what is the fair valuation as on today, whether the company is going to meet its liabilities based on the fair valuation principles. And so a lot of these things are coming up, and therefore I believe that the whole change has moved into futuristic, that even as an auditor, so on both the sides, I would say that based on the reporting that is now required, the change in reporting, I think so we will also have to change the way we do our audits. We cannot be just, I would say, with due respect to every professional that depend on our articles or our staff. We would have to have a much more comprehensive and technical team also. We would have to have a lot of processes built within our audit cycle, I would say. A lot of SOPs, a lot of documentation that would be required, because for each of these things, like you rightly mentioned, that there is a lot of judgment that comes on the part of the auditor also when they are opining. So it's not that 3 plus 2 is equal to 5 and now you are giving an opinion on 5. It is like what 3 plus 2 can be, sort of a thing. And therefore, a lot of judgments on the side part of the auditors would also come in. And I believe that it's a big shift that is happening, and we all need to gear up, pull our socks up. And I think as chartered accountants, definitely we are competent to deliver. It's just that we need to have those processes and the checks and balances in place, and definitely the fees that we get.
Yes, Vishalji. So also take this opportunity to extend a very warm welcome to CA Preeti Savla, the Vice Chairperson of the committee. So Preeti would conclude the session after we finish the questions. So we've got a lot of questions. The most important question, Vishalji, is can we have a copy of your presentation? Most people have asked that.
Yes, I'll share it with you, and then the committee can share it with you.
Sure, we'll just place it on the website or some appropriate place.
Perfect.
I reckon a few of these questions have come in before your presentation, because I was sitting through the presentation. So those questions which have been already answered in your presentation very clearly, I'm not going to repeat. But if you do feel I have not taken your question, you can always mail us your question and we can send it to Vishalji for answering. But I'll take the most important 10 questions. The first question is, a company is in its pre-operative construction stage. Should I show it under trade payable creditors? Because I've not yet, gone ahead with my project. How does it talk vis-a-vis capital work in progress? Anyway, it will be sitting in capital work in progress.
Yeah, so if it is in the pre-operative stage, definitely it would be as a capital work in progress. So I think so one was with respect to the trade payables. So whatever would be on the debit, there would be a corresponding credit under trade payables unless it is funded by equity or something like that. So the two disclosures that would be impacting. Definitely the CWIP related. Two that we discussed was first with respect to the aging, that how old the CWIP on the historical balance is appearing in the financials. And second is if there are time overruns or cost overruns. So with respect to CWIP, that would be there. And on the trade payable side also, the aging table that we had mentioned, that would also be required to be disclosed.
Yes. So the answer is creditors, whether it is for capital goods or for normal purchases and services, will both have to be disclosed. And CWIP also, whatever you put into CWIP, you have to age and show.
Correct. True.
The second I'm not taking is the small company. I think the CARO is very clear on where it applies, where it does not apply. There is also a sequence to it. So someone has asked, so this is very common in SAP. The person has asked where there is a aging for trade receivable, trade payable, CWIP, etc. For the first question is, do we have to give comparatives of the previous year, Vishal bhai? Do we have to give comparables of the previous year for all these items?
For the trade payables?
Yeah, all items in Schedule 3.
All items. Because if you see the, I would not exactly the preamble, but the Schedule 3 says that comparatives for all the amounts have to be given. And that is where I mentioned, friends, that we have to start from yesterday, if not tomorrow. Because the responsibilities that are there, and let me be very candid, we are all professionals, and especially for the SMEs, where there is a lot of hands-holding as auditors that we have to do, to be very honest and frank on this platform. And therefore, I would request that we have to start, and that is where I said that start building the March 21 financials, ask the companies to build on the 21 financials, and therefore that would give an insight about where the difficulties are coming on populating various numbers or the MIS or the data that the system would go up by way of the reports, and how they need to be modified, and therefore March 22 might be relatively easier.
The next question is something to do with GRIR aging in SAP. They say I have only one entry in GRIR. How do I do the aging? But in my view, and you can correct me if I'm wrong, when you document every liability, the GRIR gets created on the date of liability. So if it's still sitting in GRIR, but it has not moved to a vendor account, you have to give that aging as well. That's your unbilled.
See, what happens is that when the GRN or SRN is prepared, that is where the GRIR gets created. So like you rightly mentioned that on each GRN or SRN, a GRIR typically gets created. And then when the invoice comes, then from GRIR, it moves to the trade payables or the vendor accounts. Now, from the financial statements perspective, what my experience says that ultimately the balance of GRIR is parked as a trade payable only. When we do the mapping of the trial balance with the financial statement groupings, in that case, the GRIR would definitely be part of the trade payable because the money, the goods or the services have been received. And in such case, I agree with what you mentioned that aging for such balances would also be required to be done. It might come in the not due column, but to match the overall numbers, they would still be required to be given.
So it's something like this, Vishalji, just correct me if I'm wrong. So you have balance sheet, you have your property, plant and equipment. That's a static. You're expected to use it long term. So there they were very careful. What you have not capitalized, you now have to show me the aging, which is CWIP. Now they said for revenues also, you have an aging scheme. Now
Absolutely.
If you come to your share capital, you don't talk about aging because it's expected to be permanent. Then you come to borrowings, they made you classify short-term or long-term based on operating cycle. So they were left with only one part of the balance sheet, which was your trade payables, and now they're asking you to age that as well.
Absolutely. So, and that is what I said, that now if you forget as an auditor, let us say that you are an analyst. Now with the numbers that are available in a set of financial statements, what analysis can you do? Just think. I think it's unbelievable. It's unbelievable. And you say whether it is transparency or whatever, but a lot of insights that of the companies would now be in public domain. And that is what we need to take care, I would say, especially as auditors, that, where I said that you have to map numbers and all, you have to ensure it is correct, because I know Sri Priyaji would be a better judge, that I would not be surprised that even for private companies and all, XBRL filing comes and all these, the government says that you put all these numbers, and then you start throwing exception reports and issuing notices to companies and auditors also. I don't see that day far off, to be very honest.
What is unbilled payable is what is a generic question. Again, many people seem to have asked.
See, unbilled payable is like, I would say, something like a GRIR, that, where the material or services have been received, the invoice has not been received, and the liability has been provided or created in the books of account. And that is what would be an unbilled payable. So where the bill has not been received from the vendor.
The next question is, how do you define a dispute?
Great. So, like I said, that dispute, first of all, it is not necessarily something which is there in the court of law. I would say, when we talk of the Schedule 3, the receivables and payables, where the disputed and undisputed classification has to be done. I would say a dispute would typically mean that has resulted in the payment not being done, either receiving or the payment, the outflow or the inflow. So like I gave examples that, so there is a difference, there is some qualitative parameter which has not been made. So the person who is buying the goods is able to consume it, but it is not, so what was there in the purchase order, the quality parameters which were given and what were delivered, there might be some variation. And because of which the payment has been stalled, though the material has been put aside or it has been consumed, and then I'm negotiating with that person saying that, see, the price quoted was X, but it is of an inferior quality, and therefore I would be giving X minus something. So I would say even this would be part of a dispute if we are able to document it. So the guidance note also very clearly says that it need not be a legal dispute, but they should be able to demonstrate that there is a dispute by which the payment is withheld.
And very interesting, Vishalji, is the same concept has been, for those of whom who are practicing in the insolvency space, this is a big thing. Because an operational creditor who has a dispute can't file an application. So the Supreme Court came up with one landmark decision, which is called as Kirusa versus Mobilox, or the other way around. But they finally went on to say it's not necessary that it should be a suit or a proceeding. So today you have a mail, but again, one has to be very careful. Your client can't send a mail today on let's say on the date of your signing, which is June, and say what I had to pay 2 years back is disputed. So the dispute should exist as at the balance sheet date, and it should be evidenced by some correspondence on why they believe it to be a dispute, because it becomes very easy for people to transfer into a disputed bucket to look good. So
but like I mentioned during the course of my presentation also, that a dispute or not a dispute would also now be under scrutiny.
Correct. So you need to have some paper to evidence a dispute, and unless otherwise proven, it's undisputed.
True.
Okay, some of them are very detailed questions, but you could refer to the guidance note. But in any case, I'll just put it out. Whether trade receivables should be taken net of provisions or gross for calculating the ratio.
Trade receivables should be taken net or gross?
Net for calculating the ratios.
I believe the guidance note says it should be net. Like I said, the annexure B to the guidance note, it gives the details about the computation of the various ratios that have been given. And since there is already a provision against that, it is actually not a receivable. You have impaired it, it is credit impaired, and therefore it should be taken net.
So by the same token, do we age the net receivables or the gross receivables, Vishalji?
So the aging, because there are categories about credit impaired or significant increase in credit risk, that has to be at a gross level.
Okay, done. in the context of title to an immovable property, so I'm taking those questions which I think will have a very large impact. In the context of title to an immovable property, which document confirms the title? Is it an encumbrance certificate?
So see, I would say what the guidance note also says, that any document which give evidence of the legal ownership towards the company. So the easiest would be, the conveyance that we normally say, that would be there as a title document. In case of lease, it is the lease agreement, or if there is, like you said, the encumbrance certificate. If that gives proof of the ownership towards the company, then you can definitely consider it as a legal title.
In Tamil Nadu, we have these concepts of A registers. Your revenue records can also be used.
Yes.
Ask your client to get the revenue, the patta, or in the respective territories. So anything that helps you to substantiate in any government record that you're the owner of the property.
Correct.
Even if we do not have property as fixed assets, then should the word PPE be used?
So PPE is property, plant, equipment. So it's not just relating to immovable. I think the question is that in the fixed assets, we don't have immovable property. We just have, let us say, the laptops or the plant and equipment and furniture, fixture, vehicle. So still, yes, the heading would remain property, plant, equipment, because that is the name of the standard now. And it talks of property, comma, plant and equipment. So it would still be there according, like that only.
Yeah, so I'm going to ask Vishalji, and my favorite question, how do we check for strike-off companies?
Ma'am, I should ask that to you. We have had a lengthy discussion on that how are we planning to go ahead with it. Like I said, it's a humongous task on both the sides. The clients do not have the details of the CIN or the name, in which the way in which the names are written in their systems are all based on their convenience. And I believe, as per my experience, that the only thing that can be common is a CIN. So we have to educate our clients to at least start creating the database, put somebody on the job and get the CIN affixed of their masters, I would say. And it would be anything. It can be a vendor master, it can be a customer master, it can be any master. So wherever the word company comes, or whether I would not say the word, but wherever there is a company entity, the CIN, at least the client should keep ready. And hopefully Sri Priyaji would be able to give us some tool by which from the MCA we are able to have a list of all struck off companies as at 31st March 22, by which at least then we are able to do a VLOOKUP and report correctly.
Sure. And I was just thinking the way one actually goes about it is, because I've seen in a lot of our clients also, they don't even write the full name in the vendor master. So you will only have XYZ, or they could be given. So my suggestion is, you at least for the vendors you're transacting, ensure that you have, the PAN number, look for the 4th digit C, then go and find out the exact name. So you at least ensure that this year your client is able to build it. We are in talks with MCA to do something on struck off companies, but as of now, the only way to do it is to take all your C cases, go one by one and look for it in the MCA website. We'll see if we can develop something at least simple to, look at some kind of a scraping possibility, but give us time. Sure. More importantly, Vishalji, how do you report these transactions with struck off companies, comparative numbers for the previous year?
No, so what I believe is that, see, we'll have to have two database, honestly, and MCA also we will have to request that each year end, we don't want on a monthly basis, but as at each 31st of March, and maybe maybe they would have to do at each quarter end, because not all companies would be having March end as their year end. There would be December end also, and I've seen September end also. And therefore, we have to request MCA that whatever database or whatever they are planning, it has to be done at each quarter end. A master list is available by which we are able to report. That is what I said at the time also, that it's a humongous task, and difficult how we would be able to actually do it.
Vishalji, this is the last question. Whether fair valuation of investment properties by a registered valuer is mandatory. 2, whether valuation of internally generated goodwill is also to be done by a registered valuer.
So fair valuation of investment property is a requirement, like I said, under Ind AS. And so what Ind AS investment property mentions is that you follow either the cost model or the revaluation model. So, and where you are following the revaluation model or the fair value model, there you'll have to do the fair valuation at each year end. But at the same time, it mentions that where you are following the cost model, in the notes, you have to disclose the fair valuation of the immovable property. So in such cases, the fair valuation would be required because it is a requirement of Ind AS. So it would not form part of the numbers in the balance sheet, but it would come as a disclosure wherever we are following the cost model. And where, if you see, as far as my memory goes, the Ind AS says that you need not get the fair valuation done every year unless there is a significant movement. And otherwise, you can do it at a reasonable time, let us say 2 to 3 years. If there is no significant movement, then a fair valuation, you get it done for disclosure purposes every 3 years or so, and that would suffice the requirement of the Ind AS. So that was with respect to the first. The second one you asked was
goodwill, internally generated goodwill.
Internally generated goodwill. See, there is no need of fair valuation for the internally generated goodwill. If you check the accounting standards, what it requires is the impairment testing at the end of each period. So because goodwill is internally generated, you are adding that based on the developments that have been happening or the costs that are being incurred. And what the standard requires, it is now like an intangible, and therefore under intangible, you will have to get the impairment testing done at the end of each reporting period or at the year end. So in that case, it would not be fair valuation, it would be impairment testing. And since there is no fair valuation required for the goodwill, the requirement of registered valuer, it would not be required.
Sure. And Vishalji, thank you very much. And I'm given to understand we have 2,500 participants. So if you were to describe this CARO in, let's say, 10 words, just adjectives, and Preeti can add and I can add, what would you describe this as?
Well, I think for Schedule 3 and CARO, both, I would say that I'm just giving a background on that this is the maybe 5th or 6th presentation that I would have done. And each time it gives me goosebumps, let me tell you very, very honestly, because the extent of reporting that is expected from the auditor, especially, though Schedule 3 covers company also, but I would be more concerned about our auditor friends. It actually, I would say it's extremely challenging, extremely interesting, and I would say as professionals, I feel that this is the time that we would be able to prove to the government, to the regulator, to the stakeholders that what actually chartered accountants are if we do the work diligently. And I am confident that all of us would be doing it, but this is the time that we need to prove ourselves. This is what I would say.
Absolutely, Vishalji. Actually, I think you summarized it very well. I think CARO is all about empowerment, and empowerment to whom? Empowerment to the auditor. So today, if a client says, let's talk about this, you tell him, sir, it's a black and white question. I can only say a yes or a no here. So it makes your own audit task a lot simpler. So thank you very much. And thank you, Sarika, for this constant effort on this program, on mails, WhatsApps, etc. I wake up to Sarika's messages every morning. So thank you very much. And over to Preeti ji, who's of course been my total pillar of support. She's extremely diligent and she's there all the time. Could not join initially in advance. Over to Preeti ji for the word of thanks.
Chairperson of the CLCGCs, CA Shri Priya Kumar, my council member. Very intelligent and beloved Central Council member, I can say, CA Vishal Doshi. And as regards to the topic concerned, new CARO 2020, I can share with all of you that the Vishal Bhai, in the last term we were together in the region, And the way he has done, actually, when it has been announced that new CARO and the proposals have been announced, the publication was out immediately, even though it was not mandatory for that period. The publication which have been brought by CA Vishal Doshi in the last term also, the common mistakes found in the reporting by the auditors, the excellent. And whatever as regards to the audit reports, regards to key audit matters, the publications which has been brought under his leadership. And the session, this is only one of the session which all of you are hearing, but I am sure the knowledge and the talent on this subject, and the research, what C. Vishal Doshi, my colleague in the council, has done and delivered by heart, all are really upgraded with the knowledge, with valuable knowledge. And really, on behalf of the committee, I am proposing very, very well deserved vote of thanks to CA Vishal Doshi for being here. Friends, another thing, we are also having a project on this new LLP forms, version 3, which are MCA is actually making it web-based. And I can say that the chairperson of the committee is doing a lot of work for the committee, for the institute, and for all the members and stakeholders. She is like, a spokesperson and doing wonderful job in the committee, and excellent work she is doing. So the best part she is doing for the benefit of members. So congratulations to her also for first best webinar, what she is doing the efforts. And I am sure under her leadership, the knowledge of the members will increase tremendously, and the stakeholders will in turn benefit a lot. And she is also regularly in touch and coordinating with the Ministry of Corporate Affairs for as regards to this forms, this LLP forms, and forthcoming company law forms, also corporate. So the office, Ms. Sarika Singles, she is also chartered accountant, and so I have seen her working since last so many years, and the excellent work she is doing. And with this, all the talent, all of you, we will ensure that all of you gain a lot of knowledge. Feel free to give your suggestions if you require or want something, so that we can also plan those things in our committee. Thank you very much. Wish you a happy learning and a great day ahead. Thank you.
Thank you. Thank you so much, Preeti ji. Thank you, Vishal. Thank you, Sarika. And
thank you. Thanks to everybody. Thanks, Shripriya ji. Thanks, Pratibhan. Thanks, Sarika ji. Okay.